So I do want to welcome everybody to our sustainable series. This is Craig Sherman. I'll be the moderator today. This topic actually has been in discussion within Saturn and with clients for several months now. With the case for global bonds, Patrick was working on a white paper for a while, and we'll have Patrick Drum join us in a bit. And Elizabeth Alm, who did a lot of work on our impact report, will be joining us to share some of the insights they have on sustainability and diversification and how global bonds fit. But I wanted to introduce Gus Grethen because Gus is our internal salesperson. And Gus has been getting a lot of questions over the last few months from various advisors and different topics that relate to how do global bonds fit into sustainable strategies and how do they fit into client portfolio. And there's a number of topics that Gus has had to share, and including sharing our impact report. So Gus, welcome to the meeting, and thanks for joining us. I know you know many of the advisors that we talk to on a regular basis, and you field calls with, help me understand your strategy and how does the global sustainable strategy fit into client portfolios?
Yeah, absolutely. Thanks for the introduction, Craig. It's nice to be here and to be able to see some faces and talk to, just be part of the call. So yeah, there's a couple of common questions I've been hearing out in the advisor community. So, one sort of general question is where does the global bond strategy fit, and what is a good way to position it as fixed income allocation is brought up with their clients. I've heard some shy away from bringing up the global bond category as a whole because they're unsure how to articulate and develop a good story to tell around emerging market debt. Not to mention a few concerns around, performance in contrast to, say, more heavily concentrated U.S. bond funds.
Yeah, and we're going to have Patrick speak pretty soon and Elizabeth speak pretty soon, and then we'll field questions. So if you have a question, add it to the chat. And like I said, this topic has come up frequently in terms of both positioning the strategy, but also how it fits in overall. And we still get a lot of requests for stories. So Gus has been sending lots of copies of the impact report out, and Elizabeth will join us at the end to talk about, the underpinnings of our strategy and how we see both impact and sustainability in our portfolios. So now I want to turn it over to Patrick Drum. Many of you know Patrick. Patrick's the lead portfolio manager on the Saturn Sustainable Bond Fund, and it is a global fund with a mandate for capital protection and income. And welcome, Patrick, and thank you.
And thank you. And thank you, everyone, this morning for joining and addressing, or at least participating in our conversation on global bonds. And my experience is that a lot of folks are not particularly familiar, or at least fixed income in themselves is not a particularly familiar landscape. And for those who are inexperienced investors, the familiarity may extend much more to the US markets. But when you start moving and creeping outside the US borders and looking internationally, you start observing a bit of the familiarity kind of ceases. And it's a bit of that home bias. And our job here is to kind of help elevate that conversation, offering that opportunity to get you a little more familiar. I think one of the things that's most important about, we're all very familiar with the rationale of a globally diversified portfolio, and the rationale to own equities in a global sense also extends to fixed income, because it not only offers those important asset allocation components through both diversification, added sources of income, and that important shock absorber when things go bump the night as it relates to sort of the risk on investments. So part of what I'm going to try to do is just start us off and walk you through some of the lay of the land, kind of walk along with me here. And we got two graphs here. The first on the upper left-hand corner is a pie graph. And the organization is known as SIFMA. It's a bit of a mouthful, but it represents the Securities Industries and Financial Market Association. And what they do is they kind of take they take stock of the total outstanding landscape of both equity and fixed income. And this represents the total debt stock that's outstanding as of 2019. The reports usually come in about the third quarter of every year. So at this particular point, we're just a hair under $106 trillion. And as you can observe in that pie graph, the United States represents 39% of the total global debt stock. And I think that in itself is an important point to start with. Just if you think about it, most investors who do allocate to fixed income investments, particularly just the US, they're essentially kind of excluding 60% of the investable universe. put it in a little more in a caveat way that I think about. We all know Baskin-Robbins 31 flavors. If you were just to invest simply in the US market, you'd be leaving essentially 19 flavors off the table before you even enter the door. So our job is to try to help bring in that broader set of investment opportunities. And in continuing, we see that US again is 39%, Europe is 21%, and that represents 60% of the global stock. But what I find most fascinating and more interesting is the emerging markets, where we see it at 16%, and then other DM or other developed markets at 6%. Emerging markets and other developed markets have really grown in the last few years. In fact, emerging markets just exceeded 10% of total global debt stock just in the last 5 years. And then it paints a bit of a picture of the lay of the land. But one of the things I've been finding interesting is as we're looking as to what the future looks like, is looking at what an IMF kind of ranking of GDP of countries by purchasing power parity. We find in 2016, compared to a study that Price Waterhouse did, as to what the world might look like in a ranking of global GDP. In 2016, we can see that China ranks first on a per person's purchasing power, followed by the US, India, Japan, and Germany. And just looking at the top 5 in the forward rate, and again, we know that this is a forecast, and forecasts are subject to a variety of assumptions and so forth. But in going with this, and I'll help give a little context, China is still ranking first, followed by India, US, Indonesia, and Brazil. What I find fascinating is only one developed economy is positioned or anticipated to be among the top 5. And this in part really does kind of make a bit of sense. Most emerging markets represents of the world's aggregate of total GDP. Emerging markets represents now 59% and is expected to be expected to be 70% by 2030. So in less than 10 years, it's going to represent over 2/3 of the global GDP pie. And additionally, 85% of the world's population lives outside of Europe and North America. And that in itself really highlights economic growth, as well as population trends, and overall essentially consumption and raising the standard of living. And in part, that makes a lot of sense. And we should probably see along that coinciding growing of emerging market debt and other developed market debt. And as we go to the next slide, what we're here is trying to explain and give you a little an overview, and it's a busy slide, and I'll kind of break this down. But it's stepping on just sort of the lay of the land and what the lay of the land in the future may look like. Here we're trying to say, okay, what is the investment return characteristics? And here I've captured 29 different benchmarks. And here we break it into 4 quadrants. And really the message here is that we're trying to capture the risk and return attributes over a 12-year horizon. The reason I picked 12 years is that's really when most of the emerging market benchmarks started or were being formalized. And there are 4 quadrants. And really our objective as a true spirited investor is to identify securities or benchmarks that are going to provide essentially lower risk with a higher return. But as we start on this quadrants, on the upper northeast quadrant, we can see the first quadrant is high risk, high return, followed by the lower risk, low return quadrant. And as we continue, low risk, low return, in the very top northwest quadrant, you're going to find higher risk, low return. And that's a segment we really kind of want to avoid. Our goal is to target and focus on lower risk and higher return. On the subsequent slide, we've circled a few that we know that have a lot more of a commonality or a little familiarity. In walking through this, in the high risk, high return area, we can see the S&P 500 index. And over a 12-year period, the annualized return is around 15%, as well as its standard deviation, interestingly, about 15%. The MSCI ACWI, which is the MSCI World, is emerging market equities. And we can see that it has a higher degree of volatility with a little less rate of return when compared to the S&P 500. And that in part makes some sense. Now, if we were to kind of jump and hopscotch all the way down to the bottom, where we see US T-bills under the low risk, low return, that in itself makes sense. Because essentially people own T-bills for the simple purpose of really capital preservation and liquidity. But where I'm creeping towards is lower risk, higher return. It's interesting to point out that the majority of these particular holdings, such as circled in there, is the JP Morgan EMBI, which stands for the JP Morgan Emerging Market Bond Index, along with an aggregate of other emerging market as well as US fixed income asset classes. And what it points to, and I'll show on the next slide, is really the risk-adjusted returns of global fixed income as well as US fixed income offers a very compelling argument from an investment standpoint. And again, we're in a bit of a busy, but there's a lot of dissecting, a lot of data that I was going through. And let me walk you through the highlights here. So what I've done is measuring the Sharpe ratio, which is a measure of the risk-adjusted return. William Sharpe heralds himself from the Northwest, where he obtained his graduate degree in the University of Washington, and he submitted his first paper on kind of the concepts of the Sharpe ratio in 1962. It was rejected as not having particular value, but in 1990, his work actually was identified, and he was recognized as the Nobel Peace Prize for Economics for his work in helping investors discern and measure risk-adjusted returns, or basically providing information. What it does is that you're looking for securities or benchmarks that are higher relative to meaning the higher the number, the higher the risk-adjusted return, versus if it's lower, essentially you're getting more risk for that particular investment, while volatility. So walking through this, on the far left column, you'll see the asset classes, followed by the ranks in each of the security benchmark classes. And then you'll see a 12-year, 10-year, 5-year, and 3-year. And under the 12-year scenario, you'll see a ranking with green being the absolute highest, what's known as the Bloomberg GCC Credit Total Return. And that's essentially bonds that originate out of North Africa and some of the Middle East, followed by US high yield at 1.27, US investment grade at 1.26, and then a variety of other global fixed income. What I find particularly fascinating, among the top 10, there's only one equity class, and that's right under that bar, the S&P 500, earning 10th rank. And what's also, as you can observe, and it's not sorted out because it's sorted by its 12-year from high to low. There's a bit of a congruency among the 10-year and the 5-year and the 3-year for each of those global bond benchmarks. That sort of kind of ranking, the top third kind of tends to hold its top third holding, while the middle third and the bottom third there's some a migration, but by and large, you'll find that there's some sort of stickiness to that. Well, in Elizabeth and my job and our work is that we essentially can focus and allocate this sustainable bond fund and global fixed income among any of the investment securities of those top 9 ranked securities. Really, the takeaway from here is that global fixed income really does, as well as US fixed income, offers a favorable risk-adjusted return argument that really does merit consideration in a diversified portfolio. And now I'll pass this off on to Elizabeth, who will talk a little bit about our investment process.
Thank you very much. Patrick spoke very well about how global bonds serve as a great diversifier in addition to overall portfolio allocation. But generally, specifying global bonds really isn't enough. It's essential that as portfolio managers that we choose investments within this asset class. An overlay ESG integration is really a key part of this process. Through our work, we've really observed multiple global bond funds that have very large allocations to Chinese government issuers or unstable economies such as Venezuela. So out of all of the flavors that are open to us in a global bond fund, our job is also to pick the best ones that are going to add the most value for our client's portfolio. And this slide is sort of detailing where we are in the ESG market currently. You see a lot of news about the exponential growth of ESG linked issuance. The chart over on the right-hand side of the chart really looks at green, social, and sustainable issuance through the years. And it's exciting that it's reached about 500 billion in 2020 and is expected to grow exponentially in the coming years. But going back to the first slide, where Patrick mentioned the overall size of the bond market at 105 trillion, the pie chart on the left-hand side of this slide shows that these ESG-linked issuance only represent about 1% of the total bond market. So because labeled issuance is so small, we really need to go outside of green bonds or social bonds to construct a portfolio. Not only that, but to find good value and exciting new opportunities. And as part of that, it's very important to have a very strong internal process for ESG integration. This graph details our process, and central to this process, right in the middle, is capital preservation and current income. However, ESG is integrated, very seamlessly into our fixed income security selection. Up at the top of the chart, as with any bond manager, credit fundamentals are key. We're looking at balance sheet, financial resiliency, and of course, governance. But unlike in an equity portfolio, going on to the right-hand side of this chart, we also have technical fixed income considerations that we need to incorporate. This includes curve positioning, what maturities do we want to buy, coupon structure, relative value, which securities are we choosing relative to others. And in the case of a global bond fund, we have to consider currency as well. And the next two components of our process, are related to ESG, and I'll go into more details on the next slide, but we are very carefully looking at risks related to ESG. So, climate change, carbon risk, we're looking at regulatory or transitional risks, and anything that could impact the credit or future value of a bond holding. But we're not only using exclusionary tactics. Moving on to the very left-hand side of the chart, we're also looking at opportunities within the ESG space. And we think this is a very important component to ESG integration overall. So we're looking at contributions to the Sustainable Development Goals, resource efficiency, obviously business ethics and diversity, but also, what sectors are these holdings in, and can they maybe lend to green infrastructure? And just the energy transition alone is going to create a lot of potential opportunities in the future. And this slide is kind of goes into detail about how we look at ESG and what's important to us. If you want more detail, we have a full impact report, which we report our holdings within the framework of the UN Sustainable Development Goals. And we've also done a previous webinar specifically on these impacts. But in the context of global bonds, I'm going to point out some of the important attributes that we look at. Starting on the right-hand side of the slide, upper right, one very important component, of course, is looking at carbon risk and climate change. So in terms of a global context, really, what are the physical assets? Where are the physical assets? Business sector, contribution to or mitigation against climate change. And this chart details how our sustainable funds measure up in regards to carbon intensity versus the MSCI All-World benchmark. And carbon intensity really measures the amount of emissions relative to sales. And we're very proud that our funds have 72% and 75% less carbon intensity than the index. Really shows that this is a tremendous focus of ours. And one other, moving down in this slide, it's not enough that a company has a good marketing budget, maybe a good website, and a lot of money to put towards looking good in ESG. We're also sort of trying to sort out the companies that truly incorporate ESG into their corporate strategy relative to just use it as marketing. And one of the ways that we can do that is look for companies that actually set targets for, in this case, we're reporting on who set at least one quantitative target for a UN Sustainable Development Goal, and then makes progress towards those targets. This is we found a really good way to see what companies are good actors. And one of the, we report on several sustainable development goals, but the one that I'm going to focus on today is, I think, one that really encapsulates the focus on where the opportunities are in the bond space related to ESG, and that's specifically SDG number 5, which is gender diversity. And so the stats that we report on and that we look at really are supported by research. In this case, we're looking at the percentage and number of women on board. which a lot of research papers have shown really does correlate to better corporate profitability and even a better stock price. So we're very excited that both the Sustainable Bond Fund and Equity Fund, have significantly more holdings with 3 or more women on the board relative to the MSCI index, 78 versus 37%, as well as when looking at the same stats from a percentage point of view. 63% have 33% or more women on the board for the Sustainable Bond Fund relative to only 20% for the MSCI All World Index. But data is always an issue in the ESG space. So we also go one step further and we create our own data and do our own research. And that moves to the very bottom left-hand portion of the chart, where we're actually looking through every single holding and we're looking at their sustainability or CSR reports and seeing who specifically reports on and mentions each SDG that we report on. In this case, this is looking at who reports in what sector on SDG number 5, gender diversity. But the exciting thing about managing a global bond fund is that we're not just constrained to opportunities within the US. And with every SDG, we like to give a case study or a story about exciting opportunities that we're able to invest in. And this December, we were able to purchase the first women's leadership bond for the Sustainable Bond Fund. And basically this bond has been used to give loans to organizations and enterprises that specifically enhance women's empowerment and women's economic advancement. And this includes 8 loans to some microfinance organizations, but as well as direct loans to women-owned enterprises in India, Indonesia, Cambodia, and the Philippines. So it's very exciting that to be on the cutting edge of the sustainable space and really able to be able to do that, we really need to run and to look globally.
If you look at the MSCI All World Index, year over year from 2019 to 2020, it actually drops in terms of the number of women on the board. Whereas an active manager, where you and Patrick are putting the strategy together, you can be very intentional about which holdings we'll have and making sure that it aligns with how we manage the fund, but what our clients are looking for. And it really lines up with SDG 5, where a passive strategy or an index strategy, you can't control the result there, even
Absolutely.
how much changes in the index. So I'll bring Gus back in. Gus, are there any other questions that you're getting from the field that maybe you want to share with either Patrick or Elizabeth?
Sure. Yeah, thanks. There was one question I think that's worthy of bringing up here. As portfolio managers, how are you guys managing or navigating this low interest rate environment?
I'll start with that if that's fine, and certainly defer to Elizabeth if she has comments. So we have a big playing field. We're not, we don't have just to run to first base or second base. We have the entire field to look at. And it also, we spend a lot of hours during non-market hours trying to find and track the market. But it also has a lot to do with structuring and issuance. We are certainly hitting a low rate interest rate environment, in as though we've seen quite a bit of pronounced uptick in the US 10-year, overall still historic 40-year lows. And it has a lot to do with structure and diversification. I mean, right now we're still finding great opportunities both in the United States for investment grade, high quality. Some of them are floaters, some are step up particular issues. But on a global standpoint, we do have exposures to, for example, Mexico and Brazil. I will caveat a little bit of an important aspect on that. I mean, you were able to get at least 300 basis points in excess of what we're seeing in the US Treasury curve. And then, but to mitigate some of the credit concerns of these regions is that we own actually supranational bank issuers such as KfW or the World Bank IFC, the International Finance Corporation. And they provide lending to direct businesses in that region. So you essentially get a AAA credit. In fact, one of the bonds, is a green bond, and the other one is not, but they provide funding in that particular region with a AAA credit with that particular yield enhancement of that region and that currency exposure. So it does provide us these opportunities to allocate the portfolio with differing levels of exposures, of return, duration. I really kind of put it as an analogy of a quilt. And our job is trying to kind of construct an environment that's going to provide that priority of capital preservation, current income, diversification, and most importantly, when things go bump in the night, you can look to it as to provide that safety. And we stitch this through by allocating different segments of the portfolio, both with floaters, with some international exposures, some US exposures, and then one in particular that Elizabeth was highlighting, this new impact note in particular that we haven't exposed to Asia. That in itself is offering just slightly and under a 4% yield for less than 4 years. So we try to allocate the portfolio in a manner that has that resiliency, but these expressions that we trying to find through the integration of environmental, social, and governance factors to drive performance and, more importantly, the investment objective of capital preservation.
The strategy you run can be 40, it's a global strategy, 40% limitation in any one country. So we can't invest in the US. I mean, I think that's one of the things we want to make sure that we're saying. It's a global strategy with the ability to have an impact on both outside the US and inside the US. So
Absolutely.
that's cool. Yeah. And then maybe to the next, this webinar was on global bonds for achieving impact and diversification, but really it's going to be a two-part discussion, because the next webinar we're going to do is on the equity side, because we're seeing the same opportunities, particularly on the equity side in some of the developing markets, and we'll use the next webinar to really go a little deeper on the equity opportunities in the emerging markets and in the developing world, and where Saturna is finding opportunities there. So if we have no more questions from the audience, we thank everybody for the time. Thank you, Elizabeth. Thank you, Patrick. As always, your insights are welcome and well worth it. And I know the team works very hard to both protect capital, but generate income for our clients. So you make a strong case for where global bonds fit in. So thank you very much. Gus is available for any calls you might have. He'll welcome a chance to send the slides. The slides will be available, so we can send the slides out. And if you need a copy and a walkthrough of our impact report, we're available to do that. So thanks everybody very much. That's the end of our time, and we appreciate you joining the Saturna Sustainable Webinar Series. Thank you.
Thank you. Thank you for joining.
Thank you.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Saturna Sustainable Funds and a current prospectus or summary prospectus, please visit saturnasustainable.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing.